morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. US and China signed the first phase of the much-awaited trade deal. Donald Trump says tariffs will be eased as soon as phase 2 is signed. Russian Prime Minister Dmitry Medvedev resigns after President Vladimir Putin calls for sweeping changes to the constitution. Mikhail Mishustin is named as Medvedev's successor. South American conglomerate Synergy Group and New Delhi-based Prudent Asset Reconstruction Company are the only bidders for Jet Airways, sources tell BloombergQuint. India's trade deficit narrows more than estimated to $11.2 billion in December as imports fall for the 7th straight month. After nearly 2 years of tariffs, counter-tariffs and barbs exchange with each other, the US and China finally signed the much-awaited Phase 1 of their trade deal. But President Donald Trump says that the tariffs on China will remain until the second phase of the deal is signed. Selina Wang of Bloomberg News reports.
We already started to see some divergences emerge at the event with the U.S. officials very excitedly hyping up this deal. Trump saying that this is righting all of the wrongs of the past. But the China delegation was much more subdued, focusing more on all the progress that still needs to be done. And in terms of what's being written in state media, it's much more of a cautious, optimistic approach. You even have the Global Times questioning whether this deal is going to fall apart, asking the question of whether it's feasible for a deal like this to hold through, given that U.S. and China strategic relations are clearly on the decline. You also have an effort to frame this deal as an equal agreement. For instance, CCTV, after actually running a 20-minute live remarks of Trump on the state broadcasting network, they actually pointed out that this deal is about balance and equality. On top of that, you also have the People's Daily outlining that this deal is already in line with China's been doing in terms of economic reform and opening. This isn't really about China giving up concessions, but it's in line with what they've been doing. And in fact, when it comes to intellectual property and financial commitments, a lot of what's been outlined in those 90-some pages have been announced here and there in bits and pieces in terms of the reforms China has been making over the past couple of years.
Well, and there are still some details that need to emerge. I think some of the details came out. China can actually back off from the deal if US reimposes tariffs. So that is one thing. And they will have to do a number of things in order to make sure that the deal stays, which is import $200 billion worth of goods. But there are some there is some lack of clarity. For example, soybean prices, which is the center of this all, and soybean prices have started plummeting after the base price at which China might buy the soybean from the US is also not known. So lots of details awaited. What the markets did is interesting. The US markets, of course, the Dow topped 29,000 for the first time ever and closed about 29,030 or thereabouts, which is about a third of 4%. But as you would, if you would seen the US markets last night, you would know now that while the levels were topped, the US markets ended well off the highs of the day, and that's something you have to keep in mind. And I think Asia too is showing a very mixed picture in the session today. So the biggest news for the month of January is greeted with a bit of a whimper, maybe because some of it was priced in. Let's ask Seth Freeman. He's Senior Managing Director at Glassratner Advisory Capital, joins us right now on the show with his thoughts. Seth, good morning. Thanks so much for joining in. What's your sense, Seth? Were there no surprises, and as a result of which the markets are reacting the way they are, or the markets had priced in a deal of this nature in the first 15 days of January?
Well, I think the markets anticipated more or less what we got, although it's important to note that the White House...
Seth, I think I've got a bit of a audio issue with your line. We'll try and just repatch that. But keep in mind, one, if we just look at what the US markets have done in the last 15 odd sessions, or what world markets at large have done in the last 15 odd sessions, that will tell you the story about what the markets were already factoring in. Remember, we greeted New Year 2020 with a tweet from Donald Trump saying that something like this is about to happen on the 15th of Jan. So this was known. It's not an unknown, and which is why I think the fact that there are no big surprises to this deal is leading to the markets reacting the way they are. Is it back to business? Probably is. Are the markets now waiting for phase two? Because yesterday, if you heard all the commentary that came in on the Bloomberg Global Network, almost all the guests who spoke already mentioned that we've already moved on and now we're looking at phase two. And it'll be very important to see what phase two happens. And that's the nature of big events, that once that event is out of the way, you already start looking ahead to the next one. And the market reaction or the market build-up of what would happen would be fairly and squarely dependent on what happens to the next event. So in this case, phase two. And as I said at just the very beginning, that there are doors left for both sides if indeed they do not meet certain criteria. Now, Seth, that is my question to you. Are now the markets already looking forward to what happens in phase two and therefore the muted reaction?
Well, sorry you couldn't hear me the first time. I think that the markets, anticipated the signing, and one of the key issues is that actually the amount of tariffs didn't change. The administration is holding off removing the tariffs until they see the compliance with the conditions in phase one. And to answer your other question, it's uncertain how soon phase two will be completed. And there are still many details to work out that were left unanswered in phase one.
Seth, so what happens? I mean, there was a build-up in the markets. We were hoping for a deal to happen. That has happened. We haven't had any untoward incident toward the deal itself. Now, does this make the new normal one of reconciliation and not camaraderie, but something to that effect between the two nations, and therefore can the world heave a sigh of relief with regards to supply chains and all of the other factors?
Well, I think we have to decompose phase one a little bit and also look at the long-term game plan here. And let's first focus on this announcement of $200 billion worth of increased imports by China, and in particular, the sale of up to $50 billion of additional, or actually a goal of $50 billion of agricultural products. You mentioned soybeans earlier during your intro. One of the things that's happened over the last 18 months is China had to go out and find new sources or expand their sourcing for soybeans, mainly from Brazil. So they're not going to be switching overnight and immediately, having tremendous new purchases from the U.S. This is going to take some time. And so I think we have to be realistic there. And in terms of these other purchases, they're supposed to be phased in over 2 years, which is a pretty long time to really have the kind of impact that might be expected from this sort of announcement. However, the intellectual property protections, the changing, or the agreement by China to reduce the demands for technology transfers is very attractive. But I do believe a key consideration for China wanting to make this deal isn't so much to break the ice with the U.S., but they were very eager to not have this label currency manipulator carried over any further. So I think getting rid of that label, currency manipulator, was very important to China.
Okay. Let's put all of this into perspective, Seth, now. And just trying to squarely look at it from a market's perspective. What happens to the EM pack as a result of this being out of the way? Focus squarely on basic economics and basic business and basic growth. Does that look okay? And therefore, is it back to normalcy for the world markets?
It's not going to be back to normal. Again, these tariff changes don't really come into effect for as long as at least a year. So I think maybe what we have is some stability and a little bit less uncertainty, and that's always positive for investors.
Okay, you bullish on the markets from these levels, Seth? the U.S. markets?
I don't know. You know, we've had an incredible run. We've already seen, you know, 3 to 5% gains in a very short time, just, you know, in the last 2 weeks. So I think it kind of depends on politics here in the United States, partly, and what's going to happen with in the UK and Brexit.
Yeah, well, and there's a shakeout at in Russia as well, which is very interesting, though maybe not that much market moving currently. But Seth Freeman, take a moment to thank you for joining in today and giving us your perspective. Really appreciate your time.
Thank you.
Well, more of the same. Not that this was unexpected. James Glassman referred to this yesterday. Seth Freeman is referring to this today. Adrian Mowat spoke about this yesterday as well. So we, by and large, knew that this was happening, but this is a big event and it's out of the way now. Markets have not reacted too much, but there are individual stocks that could react, and therefore it's also important to see what could happen to some things on the Indian shores. Remember, the SGX Nifty is indicating a start, which is absolutely flat. Just quickly mentioning the few pockets that you need to monitor in the session today. There are a few mid-sized names that will come out with the results, the likes of Karnataka Bank, South Indian Bank, Rallis, Cyient, etc. So those are the numbers that you need to monitor in the session today. But stocks that could react at 9:15 a.m. Sterlite Tech, while they've guided to some improvement going ahead, the revenue numbers, the EBITDA margin, the bottom line numbers leave a bit to be desired. I wouldn't be surprised if there's a bit of a negative reaction on the stock, though what may salvage it is the fact that the revenue and the absolute EBITDA is going to improve sequentially as per the guidance given by the management. Let's see if this helps the stock in the session today. Den Networks, amongst the smaller names that came out with numbers, margin expansion seen and is back in the black because there's a net profit number of 19.4 crores versus a loss due to the higher other income. So that's the other interesting one. The interesting bit is also for DFM Foods. Remember, there's a big reaction in trade yesterday. The promoters and other shareholders have executed the transfer of the shareholding to AI Global Investments, which is the subsidiary of US PE firm Advent. Maybe the markets would like to take this well. Let's wait and watch if the stock reacts further. And then the two aviation companies, Jet Airways, wherein we now know that there are two bids. This is as per Bloomberg News, of course, BloombergQuint News. You can log on to our website and read more about this story as well. But Jet Airways, which has had a remarkable run in the last few days, has seen two bidders. Jan 18th is their D date. Let's wait and watch what comes out from the declarations. And last but not the least, Interglobe Aviation. The Qatar Airways CEO said that they are happy to buy as much stake of the company as Interglobe Aviation can give them. And, well, let's wait and watch if Indigo reacts a bit in the session today. Anyways, let's tell you what's lined up on First Word today then. Markets have made a comeback in 2020. Darshan Mehta has put together some charts that show the changing trend. Shefali Malik will tell us what brokerages are betting on to ride in the broader market rally. Cement industry's fortunes too may be changing in 2020. Nikki Mirchanan will tell us about the shifting dynamics. And the State Bank of India may have to provide for another bulk of stressed loans in the current quarter. Vishwanath Nair has compiled a list. Well, the one change that we're talking about is the difference in 2020, and which is the broader market's performance. And while the theme was all about quality last year, the focus has turned to value, at least in the first 15 days of this year. Darshan is here with some charts which reflect this very trend. Darshan, good morning.
Good morning, Neeraj. It's been 2 weeks since the new year started, and the trend certainly seems to be moving away from quality to valuation this time around. And that's the theme, because in just 2 weeks, look at the move that we've seen. The small cap index is the purple line. It's up almost 7% in this year itself. The mid cap 100 is up 4%. The Nifty is up 1.5%, and the Bank Nifty is down 1%. And majority of that is on account of weakness that we've seen with IndusInd Bank, the results that came out. So that is certainly spooking the markets. And now let's take a look at how this year has started for the large cap, the mid cap, and the small cap. So if you're looking at the large cap end of the market, it's just 1.5% up, but majority of the gains have come in from the only company which has had double-digit returns this time around is Ultratech Cement, while some of the other mid-cap cement companies have moved 20, 30, 40%. Ultratech has moved 11%. Tata Motors, GAIL, Vedanta. So basically what you can see is that the counters which didn't rally significantly in the earlier one, the commodity-based companies, they have managed to rally, and a couple of these IT companies have managed to rally. If you're looking at the loser list, yes, a lot of companies, apart from Yes Bank, which is up 15%, majority of the other companies have actually managed to give negative returns this time around. The trend for the Nifty Bank, the mid-cap, look at the Nifty Bank. Look at Yes Bank is down 15%, IndusInd Bank is down 7%, and most of the PSU banks are down in trade. Federal Bank and RBL Bank probably are the only ones that are managing to hold on. So it's been a very weak start as far as the Nifty Bank is concerned. But the theme changes when it comes to the mid cap and the small cap end of the market. The mid cap end is up almost 4%, and look at the companies. Almost the top 10 have actually moved more than 10% here. So you can see the variance that there is moving. And look at the losses. Now, if you're looking at the losses, except for in Indiabulls Ventures, most of them have negligible losses that have come in. So this is the mid cap end of the market, and let's pull up the small cap end of the market, which is up almost 7% from the start of the year, and that actually gives an indication that there is more traction. Okay, we'll pull that up. The mid cap end of the market, 15 stocks have gained more than 10% in the past 2 weeks, and only 25 stocks out of the 100 are trading in the range, and you could see that only negligible stocks, the losses except for in Indiabulls Ventures was negligible. The small cap end of the market, look at the gains that have come in. Indiabulls Real Estate has moved 50%. Some of these counters which were beaten black and blue have actually moved up almost anywhere over 20%. So majority of them have gained more than 20%. And the losses that we've seen, except for Lemon Tree Hotels, which is down in double digit, so only one stock out of the 100 is down more than 10%. The others have managed to give negligible losses this time around. Some interesting facts about the small cap index is 10 stocks have gained more than 20%. 30 stocks have gained between 10 to 20%. So the traction is clearly seen on this counter. So almost 40% of the stocks have given you returns more than 10% in the small cap index, and 20 stocks are trading in the red currently. So that's the trend that we've seen. Some interesting points is that initially a few months back we were seeing that it was only the Nifty companies which were trading at 52-week high, and there was no traction that was seen on the mid cap end and the small cap end. You can see that has now changed. Nifty 50 stocks, only 2 stocks as of yesterday were trading at 52-week high. The Nifty Bank, none of the stocks are trading at it, but the traction seems to be moving on the mid cap and the small cap end of the market. 13 and 11 stocks have gained. Some of the interesting stocks that we want to talk about, some of the stocks that have gained. On the Nifty, obviously it's Asian Paints ahead of the numbers. On the mid cap it will be Berger Paints, and HCL Tech ahead of the numbers is trading at a 52-week high. So that's the mid cap end of the market. On the mid cap end of the market, yesterday Coromandel, because of the urea news that came out, did well. SRF, City Union Bank, Jubilant Food has been done extremely well. Some of the pharmaceutical companies, Ipca and Alchem, domestic companies that have come out, the gas companies, Balkrishna Industries and Tata Global. So this is the mid cap end of the market, and the small cap end of the market also has 11 companies which have managed to do well. No doubt companies like PVR and NIT Tech by Amphi have been classified as mid cap, and in the next revision by the exchanges will come into the mid cap. But counters like Welspun Corp has done extremely well. MCX, Avanti Feeds has been a massive outperformer of late. JK Cement from the cement pack, JM Financial, Ircon, PVR, NIT Tech. So these are some of the counters which have moved well. So I think the theme is that at least for 2020, the theme seems to be moving slightly away from quality, and not only focusing on quality, but again, mid cap seems to be finding a flavor.
Yeah, well, they are. Darshan, thanks. An interesting compilation of the data. Now, some compilation of predictions. Brokerages are betting on the market rally broadening out in 2020. Shefali is standing by with the list of their mid-cap bets for the year. Shefali, everybody wants to know what are the stocks that one should bet on. What are brokerages saying?
Well, a couple of brokerages have come out with their notes, and starting with GM Financial, they have put out a list of couple of stocks. So starting with Alembic Pharma, Canfin Homes, Chalet Hotels, Sundram Fasteners, VIP Industries, all the target prices and the potential upside are there on the screens. So Alembic Pharma, they think that US business will continue to surprise positively, and domestic revival is likely in FY21. Stock is trading at 25% discount to its 5-year average, so we can expect that to close a bit going going forward. Canfin Homes superior loan book quality over peers, and PAT is expected to grow 27% over FY19 to 21. Chalet Hotels likely to gain from the imminent upcycle in the industry. Sundaram Fasteners, their diversification into other categories, other auto categories and exports, that is going to boost growth for them. VIP Industries, their focus on product designs over utilities, something that is going to boost growth for them. BNK has also put out a note, and they are bullish on Aditya Birla Fashion and Retail, target 250. Atul Limited, CG Consumer Electricals, a 30% upside they see from here on in next 1 year. PVR and Sanofi India. So these are the stocks that they like. CG Consumer, they think that the management's focus on branding, premiumization and product innovation is paying off well, and going forward as well, it's likely to bode well for them. PVR, the stock trades at 13.7 times 1 year forward EV/EBITDA, and they expect these valuations to sustain going forward. Spark Capital has also put out a note. However, they've taken a 3-year view from here on, and they are bullish on Ashok Leyland, Federal Bank, KPIT Technologies, TeamLease and VMart. So they see almost 100% upside for most of these stocks. And lastly, there is Jefferies. We did talk about these earlier as well. So Jefferies actually came out with a note on mid-cap industrials that this year may actually be good for them. So a couple of stocks that they like from that pack. HEG and Graphite, despite industry challenges being there, they think that these two will do well, and especially considering the fact that valuations are inexpensive and the balance sheet is looking strong to them. So they see 25% upside for Graphite, HEG 53%. They like V-Guard and Havells as well, over 30% upside for these two, and they think that diversified product mix and market leadership is going to help these two going forward. They like Phenolix Industries as well, Kajaria Ceramics and UPL from the mid-cap industrials pack.
Well, that's an interesting list. Shefali, thanks so much for putting that into perspective. So viewers, now you have the whole lowdown of what's worked in the mid-cap space and what analysts are betting on in the mid-cap space as well. Let's move on to one mid-cap sector, and largely a mid-cap sector, let me put it that way, which has been doing very well in 2020, which is cement. Price hikes announced in the beginning of the year triggered a rally in the stocks. But that's not all. Business dynamics seem to be turning around a little bit for the industry as well. Nikki standing by with an analysis out here. Nikki, why are we saying that the business dynamics are changing?
Couple of factors actually behind it: demand situation, price hike scenario, all put together. Looks like the industry is in a sweet spot. But I'm going to start off with the price hike announcement first, because that's clearly a trigger which has led to an up move that we've seen across the board in the cement sector. You see all the cement stocks, for that matter, they've rallied between 5 to 28%, with the maximum amount of gains seen by Orient Cement and the least amount of gains seen by the pan-India player ACC. What has actually triggered the rally is the price hike announcement first, where you have announcement at the start of the year coming in that the prices were hiked to an extent of 20 rupees per bag for regions including East, South and West, and a 10 rupee per bag hike for North and Central regions. Apart from that, brokerages also suggested that it is during the mid of this month again that the cement dealers are expected to take the price hike, given the kind of demand situation, which is only expected to pick up here on, given that we are now behind the festive season, and this is originally the time when the construction activities usually pick up. Also, if you look at some of the data, what does the data suggest? 8 core industry index, where you have the cement production index as one of the component behind that. That is particularly moving up. If you look at the index, September, October, November, month on month, you would see the growth coming in for the manufacturing index, suggesting some level of green shoots coming in for the demand of a cement sector overall. Morgan Stanley typically says that their channel checks actually suggest that December is expected to be better month as compared to what we've seen for November. They expect improved, and the reason what they felt were moving this particular index higher were improved sand availability in Andhra Pradesh and Telangana, which is a key challenge until now, which had been rather a key challenge until now, and the partial lift of ban which has now taken place in NCR region, because of which construction activities, they have normalized to an extent, and the demand has come back to north-based players. Also, what the brokerages suggest going forward, at least Macquarie feels that the demand is picking up, and Q3 has been a fairly decent quarter, and that is only expected to improve going forward. Q4 is expected to be better than that of Q3. The factor which essentially is driving the demand out here is, according to Jefferies, they're suggesting that it's going to be the government-led affordable housing schemes which are expected to be the which is going to be a key factor driving the demand much before the infrastructure demand comes through. This view to an extent has also been validated by the industry leaders. Talk about India Cements, he said that the demand is going to be, was rather being driven by the private housing segment. And also so is the case with also one of the other cement manufacturers, Orient Cement, which has said that pickup in house construction and repair activities essentially is driving down the demand. One of the parameters which consistently now has been aiding the growth, or rather the EBITDA margin performance of all these players, will be the persistent easing input cost pressures. Look at both of them. Petcoke, domestically, international coal price, they've been all on declining trajectory. If you could pull out the chart out there where we could see how the prices have moved in all these quarters, you would see a declining trend. Do remember the fact that energy costs put together from 25 to 30% of the cost that the cement makers face overall. This combined with the shipping freight cost, which have been declining, along with the e-auction prices, which have been stable, that's also pretty much aiding the sector as a whole. What do we feel could be the outlook? Well, I definitely, along with all the brokerages, pricing discipline is the key. If these manufacturers manage to hold on or further take hikes, that's where the game lies. Also, Jeffrey says that the next upcycle for cement industry is expected to be longer, but however they feel that the pricing power would be limited to an extent.
Okay, Nikki, thanks so much for putting that into perspective. And stories around this would be there on our website, BloombergQuint.com, as well as also on the mid-cap piece by brokerages on our website. Do try and read more about that. The last piece on First Sweat today is about the country's largest public sector lender, which is SBI. We have to provide for another substantial amount in the current quarter. Loans more than 1 lakh crore issued to 10 borrowers will cross over the 180-day deadline, forcing the lender to take a call soon. Vishwanath is here to list out the borrowers and the status of those accounts. Just when we thought that things were improving because of the recoveries, there are more skeletons that are tumbling out.
Yeah, so as you know, Neeraj, what happened in June, the Reserve Bank came out with a set of guidelines, gave bankers about 180 days plus 30 to review the situation. Essentially, these are the top 10 accounts where loans of over 1 lakh crore are stuck. The resolution plans have not yet been finalized in either of these cases. Now, the issue is that if you cross 180 days without a resolution plan, then the RBI mandates additional provisioning against those accounts. So that's about 20% additional provisioning over and above what you already hold in these accounts. Of these 10 accounts, most of them are from the Anil Ambani group. There's Reliance Power, Reliance Infrastructure, there's Reliance Naval, Housing Finance, Commercial Finance. All of these companies are there, and there's a considerable amount of debt involved in all of these companies. Resolution plans are not coming by for any of these companies as of now. At least in Reliance Naval's case, lenders are considering an insolvency petition. Remember that Reliance Naval, before the Anil Ambani group took over, it used to be Pipavav, there it had been through corporate debt restructuring, through which the Reliance Group took over the company. After they took over it, the financial problems still continued, and that continues till now. So the lenders have tried multiple options to try and resolve that account. Things have failed. So the call for going for a restructure, for an insolvency petition against the company seems like the most legitimate, like the most thought out process out there, because there is an incentive for the lenders to go for an insolvency. If you go for an insolvency, you can essentially write back all these additional provisioning, the 20% that I spoke about. You can write that back, and essentially that adds to your profit. So it makes sense for the lenders to go for an insolvency if none of the other resolution plans are working out. For the other cases, though, of the 10, about 3 of them are in a similar situation. But for the other cases, there could be discussions still going on with respect to resolution. The reason for that is because you will have to book those provisions only by the 31st of March. So you still have that period of time where you can resolve the account so as to ensure that you're not shelling out more money for these accounts. But the time that is left is quite small, and you've been working on this for about 6 months. So the probability of actually finding a resolution plan, well, lenders say they are confident, but we still have to wait and see what happens on the 31st of March, whether there's actually going to be additional provisions in these accounts.
Oops, it'll be a point of conversation for sure when SBI announces its results as well. But Vishy, thanks so much for putting all of this into perspective.
Thank you,
as you would expect him to do, of course, as we've seen it happen all the last 12 months too. But keep in mind, just when we were thinking that things would get resolved and the resolutions would help, things are still not out of the woods as yet. That's all that we have on First Word today, but lots more lined up on Indian Open. We speak to Saurabh Mukherjee of Marcellus Investment Managers about what they are betting on for 2020. What does he make of this trade deal and the impact on the Indian economy and companies? Decode Sterlite Tech's earnings with Group CFO Anupam Jindal, and talk to N. Srinivasan of India Cements to understand if the pricing power is sustainable. But after this break, a full tilt towards the day's trade.